Good evening, everybody. Let me just switch on all the lives. I hope you can hear me quite well. If there's any problem with the sound, please, maybe I can just test. Can anybody react? There's also a chat. Anybody? I just want to see if you can hear me at this moment. Just before I start. Thank you, Francois. Thank you. Amazing. So let's go. Let me just switch on. I'm going to go live on TikTok, so I won't be able to share my face on Teams, but let's see how this works. There we go. Let me just put this away. So welcome everybody. This is the second webinar, the second live that we are hosting, and somebody just entered. Okay, there we go. GEPF Masterclass and Survival Guide, mistakes to avoid and wins to secure. Thank you for joining and taking the time. To everybody, I hope I'm live on every channel for now. If you have any problems with hearing me, or you can just get my reaction and I'll see and I'll get to it and I'll fix it. But thank you for being here and let's start. So just a disclaimer before I start. This is not financial advice because I can only give you advice if I take your personal situation into account. Just an outline before we begin. Actually, just before we begin, I want to say thank you to each and every one of you that came out tonight. I know that I think our most valuable resource is time. And I do appreciate anyone that takes out, even if it is just a couple of minutes of their time, to come and listen to what I have to say. I hope and believe that I will be leaving you with quite some valuable information, because just as valuable your time is, my time is as well. And that's why I take out my time to do this webinar. Maybe I'll have another one in another 2 weeks or so, depending on the interest. So just an outline of what we will be discussing today. Firstly, part one will be about a problem that's keeping us poor and stuck. Part two will be the survival guide of the GEPF, mistakes you need to avoid. Part three will be the wins you will have to secure. And in part four, I'll have a question and answer session. I am streaming on multiple platforms and I'll see if I can answer all the platforms, but I will definitely answer everybody who registered. And you will also receive the recording of this webinar if you did register. Feel free to leave me with questions. At the end of the session, I will answer and take the time to answer all questions. Just some background. I have more than 10 years of experience with the GEPF and GEPF members and financial planning. And my passion is to assist and to help people make the best choices financially. And I can promise you, if you apply what I teach you tonight, then you won't have a financial worry or an uncertainty that you won't have enough. So before, and I said we'll handle the mistakes later, but mistake number one is not verifying. So checking if a person is accredited is crucial before you take any financial advice. So I just want to show you what accreditation could look like. And I believe you can see my screen. So this is a notice or or a disclosure document that all financial advisors need to produce, and it serves as proof that they are accredited for whichever products they advise on. So as you can see, you can go and check on the FSCA's website, and this is me, and this is my code, and this is the license under which I can provide financial advice. So that is just very important if you want to avoid being scammed, if you want to avoid anything related to scams, you need to check their disclosure document, or if they are accredited to provide you with advice. That's mistake number one I see a lot of clients make. And just after that, the win for tonight, for being here and listening to me, that is your first win. I think the most important thing to achieve anything in life, you need to take action. You need to show up. So thank you for showing up, each and every one of you. Thank you for taking the time to join me tonight. So Albert Einstein, he has a lovely quote, and one of my favorite quotes of his, he says, "We cannot solve our problems with the same thinking we used when we created them." And I want you to remember this quote. We cannot solve our problems with the same thinking we used when we created them. Now, the problem is as follows, and I want you to follow with me. So the South African Reserve Bank, they have private shareholders, and they loan money to banks, which in turn loans money to me and you. So for us to qualify for a certain loan, we need to have a high enough income, and we need to be credit worthy. So if we have a high enough income, affordability, and we are credit worthy, then the bank will provide us with a loan. But the bank does not necessarily have that money. The bank will show that proof to the South African Reserve Bank, which in turn will use that to print money and to provide the loan with the bank. The same applies for our taxes. Of course, they want us to increase our level of education, because if we increase our level of education, we pay higher tax, but we also earn more. If we earn more, we qualify for more. So at the end of the day, the person that benefits is the South African Reserve Bank and the shareholders of the South African Reserve Bank. Also, the government wants us to pay more taxes, because then they'll have a higher income, and the South African Reserve Bank will also lend money to the government. So if, and the reason why I show this and as a problem is, we cannot fix and we cannot solve our problems if we listen to the people that created this problem, right? So that is the most important thing I want you to take from that slide. And I want to show you with a question. I want to show you with a question if it's better to rent or to buy. If I can get a number one, if it's better to rent or buy, and I'll give you two options. But I just want to see if it's better to rent, put number one in the chat. If it's better to buy a property, put number two in the chat, please. So it's better to rent a property of 7,000 Rand per month. That same property you can most likely rent for 7,000 Rand per month. Or is it better to purchase a property for 1 million? That same property. So I see ones and twos. Thank you. Thank you for interacting. Thank you so much for interacting. So I want to show you why that type of thinking was created by somebody else and why that is a problem. And I want to change your way of thinking tonight. So let me show you some calculations. So is it better to buy a property or to rent a property? Now let's take these calculations into account. If I purchase a property of 1 million and my bond or interest rate on that bond is 12%, and I have a bond term of 30 years, my repayment will be 10,286 Rand. And I just want to ask, can everybody see the screen I'm sharing? It's a spreadsheet. Just number 0 if you can see the spreadsheet. Otherwise, it won't make sense if I'm not certain that you can see the screen. Just a number 0, then I know you can see the screen, the spreadsheet. before I go ahead. 0 in the chats, zeros in the chats. Size is good, image is good. Thank you. Thank you. So you can see. So let me start over. If you purchase a property of 1 million and the interest rate on your bond is 12%, and you have a bond repayment term of 30 years, your repayment equals 10,286 Rand per month. Now, if I sell this property after 7 years and I have a capital growth rate of 10%, my property will be worth 1.9 million, right? If I sell that property after that 7 years, in my head, and the problem and the thinking they created is to think, if I use this property for 7 years, I sell it, I make a profit of 948,000 Rand. Is everybody with me on that calculation? Just give me a 3 if you understand. Just give me a 3. Let me see if you understand. Thank you. So I make a profit of 948,000 Rand. But my question is, what about the payments that I've made for the last 7 years? So if I calculate the payments that I've made, I've paid in total an 864,000 Rand. And if I take that into account, then my real profit is only 84,000 Rand. And I didn't take into account, but say I used an estate agent and I had to pay 5% commission, I am left with a loss of minus 12,000 Rand. Is everybody with me on that first portion of the calculation? Give me a number 4. Give me a number 4. Thank you. Thank you. I see the 4s coming in. Now, if I look at that same property that I'm renting, if I rent that same property for 7,000 Rand a month, I have a surplus, or I have access to excess money. I have extra money of 3,286 Rand. If I invest that 3,000, that difference, and I have a 12% growth, I can have, after 7 years, 397,000 Rand. So the difference is almost, actually more than 400,000 Rand. So this person, the first person, this person, is 400,000 Rand behind this person after 7 years. Does everybody get that? If I can get a 5 to see if everybody understood. Thank you. But the answer to that question was not it's better to rent. I want you to remember what the answer to this question is. The answer is not it's better to rent. The answer is you need to do the calculation. Because only with the calculation you can tell the full story. Because the situation will differ if that property was in the market for 10 years or 5 years or 2 years. So it's important that you do the calculation, and that's the answer. Don't rely on that first thinking, the problem that they've created. Because in our minds, somebody else benefits when we believe it's better to buy a property. The same if we believe it's better to rent a property. It's not us that benefits, it's somebody else. Unless you do the calculation, then you can see who benefits. And on that point of calculation, that is what the defined benefit is. The defined benefit, or the GEPF, is what is called the defined benefit plan. And in fact, it's just another way to say it's a calculation. So the GEPF's benefits, whether it be for retirement, whether it be for the resignation, and whether it be for death, is calculated by formulas. Right? So you need to do a calculation to determine what your benefits are within the GEPF, and that is what the GEPF is, a defined benefit fund. And this defined benefit has a couple of components or a couple of factors or variables that determine those benefits. And the benefits are determined by your years of service, your final salary, and those are the primary factors or the primary components. Those are the big things that impact your benefits within the GEPF. Your uniform, if you are a uniformed member, it also affects your benefits. If you purchased any years, it will affect your benefits. And if you withdrew from the two-pot, it will also affect your benefits. Just as a tip, if you want to increase your pension benefits, because it is a defined benefit plan, you just need to make sure that you increase your salary over the last 2 years. So if you increase your salary over the last 2 years, your benefits automatically increase. So who would like to see an example of an educator who earns 400,000 Rand with 35 years of service? Let me get a 6 in the chat. Let me see if people are still with us and people are willing to see the next couple of calculations. There we go. Thank you. Thank you, Francois. Thank you for the 6s. So to calculate your gratuity, gratuity is another name for a lump sum. And the formula is as follows. It's 6.72% times your final salary times your years of pensionable service. So in this case, Jane Doe will earn a gratuity or a lump sum before tax of 940,000 Rand. 940,800 Rand before tax. And that's how you calculate the gratuity. The annuity or your monthly pension is calculated with the following formula. It's 1 over 55 times your final salary times your years of service. After that, you add 360 Rand to it. In this case, if you do the calculation, Jane Doe is going to earn 254,000 Rand per year. As a monthly income, she'll receive 21,242 Rand per month before tax. I've received a lot of questions in regards to the 360. This is just part of the formula. So they created the formula, and this is part of the formula, and that is why you add the 360. Everybody understand us so far? You also have a resignation benefit. So although the calculation is quite complicated, I simplified it for this scenario. But it is 6.72% times your final salary times your years of service or your gratuity. And then you add your annuity, which you multiply by an actuarial factor, and that is determined by the GEPF. And if you do the calculation in this scenario, the resignation benefit of Jane Doe is 3.2 million before any taxes. And that is where we end with mistake number 1, and that is resignation. So when a member resigns or is just discharged and his benefit is paid into his bank account, and that is what I'm talking about when I say resignation. So when you resign, or should Jane Doe resign, she is going to pay tax of 698,000 Rand because that money is hitting her bank account. I want you to give me a 7 in the chat if you understand the tax implication, because it's very important. If you understand that if you take the full resignation benefit from the GEPF, you'll be taxed quite heavily, and that in this case it is 698,000 Rand. A 7 in the chat. Thank you, Francois. I'll answer your question at the end. So Jane Doe was also appointed pre-March 1998, right? And there's a tax-free portion if you were appointed before 1998 March. I think it's 31st March, but yeah, I think that's an error. But pre-1998, the tax-free portion for her scenario is 833,000 Rand. And her taxable portion is only 2.4 million. So there's also a tax-free portion for everybody who started working pre-1998. Now, what could you purchase from that tax that you pay 698,000 Rand? Maybe a small house, but definitely a car. So please be careful, and that is why this is mistake number 1, resignation out of the GEPF. Mistake number 2 is retiring early. Early retirement is when you decide to retire before the age of 60. Earliest you can retire is 55. So retiring early has the following effects. So normal retirement in the scenario of Jane Doe, she's going to receive a 940,000 Rand lump sum and a 21,000 Rand income. If for some or other reason she decided to go on early retirement at the age of 55, her lump sum benefit, or 1/3, would be 645,000 Rand, and her income benefit would be 14,569 Rand. And that's a difference in lump sum of 295,000 Rand and a difference in income of 6,673 Rand. Because it is a mistake, just give me an 8 if you understand this mistake, an 8 in the chat if you understand this mistake. Thank you. And the more you interact, the more value I'm going to provide. So please interact. Give me the 8s in the chat if you want me to add more value and teach you more about the GEPF. Thank you. Thank you, Astroball. And the reason why this happens, and a lot of people I've seen ask the question, why is there penalties? Why do I pay penalties for early retirement? And the reason you pay penalties is because the GEPF needs to provide that income for a longer period. So of course, if you retire at the age of 60, your life expectancy is less than what your life expectancy would be when you are 55. So the reason why they penalize you is because in their mind, they are seeing they will need to look after you, or they'll need to pay an income for a longer period of time. So the penalties, it works as follows. The amount of the reduction payable to the GEPF is 1/3% for each month between the employee's retirement date and his or her 60th birthday. So the penalties that you pay, if you look at a calculation, it's 1/3% or 0.33% times each month that you retire prior to the age of 60. So you deduct 55, you deduct from your 60 and you times that times the amount of months, and then you'll get your percentage reduction. Now, mistake number 3 is not planning. And without a plan, I'll show you why you are gambling on you and your family's future. Angel, I see your question. I'm going to answer questions at the end of the webinar. Now, not a lot of GEPF members know this, but if the pensioner dies, so if you are on pension already, so you're a pensioner, and if a pensioner dies within 5 years of retiring or being discharged, the GEPF will pay the balance of the retirement or discharge annuities to the beneficiaries. In other words, the GEPF will only pay an additional lump sum if you pass away within 5 years of retirement or discharge. So I want to show you the figures so you understand it a bit better. So this is a pension. This is for Jane Doe. The option or the example we had at the beginning of the educator with 30 years, 35 years of service and 400,000 Rand final salary. So if she passes away within the first year, her family will receive 1.2 million. If she passes away in year 2, Her family will receive 1 million. Each year that amount decreases. If she should pass away in the third year, it's 763,000. If she passes away in year 4, it's 509,000. And if she should pass away in year 5, it's 254,000 Rand. Important to note, there's no lump sum paid for a pensioner within the GEPF if they pass away after 5 years. Give me a 9 in the chat if you understand this. Thank you, Francois. Thank you, Emblem. Thank you for the 9s. Thank you for the 9s. But I do not want you to resign because of what I just showed you, because there is a solution. And I'll show you a bit later why you shouldn't resign because of this reason. Right? So just stick with us, stick with me, and I'll show you why. So please don't resign just because of that. And that's why mistake number 3 is not planning, because if you don't plan in advance, you might leave your children or your family with no lump sum after 5 years. But there's more to passing away after retirement. So there's 3 options within the GEPF. There's a 50% option and 2 75% options. Now, on the 50% option of Jane Doe, she'll receive 940,000 Rand and she'll receive an income benefit of 21,000 Rand per month. Now, on her death, her spouse will receive 50% of her pension, which will equal 10,621 Rand. So this is a benefit. After you've passed away, your spouse receives a spouse's pension, and in this case, it's 50% if you choose the default 50% option. You can also opt to take a reduced lump sum option, meaning instead of the 940,000, you take 645,122 Rand. If you decide to take a reduced lump sum option, your income will stay the same, but you will leave your spouse with 75% of your pension. And that will equal 15,932 if I calculate it correctly, but it's 75% of the 21,000 Rand. You can also opt for a reduced income option. Reduced income option is you keep your lump sum benefit, but you decide to take a reduced income option or a reduced income of 20,498 Rand. If you choose this option, you leave your spouse with 75% of that income, which equals 15,300 Rand. Give me a 10 in the chat if you understand this. Give me a 10 in the chat. Give me a 10 in the chat. So it's very important. This is a lot of members don't know this, that there's 3 options they can choose off. Thank you, Astroball, Angel, Mark Lee, Emblem. Thank you. Again, you'll need to plan, because if you just fill in that form within the GEPF, you might even not know which option you chose at the end of the day, and it has an effect on your family. So now let's get into the wins. The wins is you need to do the calculation. So calculate, because the calculations is going to tell you the truth. You cannot lie. The maths cannot lie, I should say. The maths cannot lie. And I want to show you what I mean when I say calculate. So there's another option that GEPF members have, and they can transfer their benefit to an approved fund, and they can take an income from that approved fund. It can either be a living annuity or a life annuity. In this situation, I'm making a comparison to a living annuity. And remember, this is not financial advice, because each client's need is different and it needs to be taken into account. But I want you to understand the principle that I teach tonight. So this member, Jane Doe, who has 35 years of service and has an income of 400,000 Rand, and that is an educator. decides to transfer her resignation benefit to an approved fund. And the reason why she does this is because she doesn't want to pay any tax. So she transfers that 3.2 million to an approved fund, and she is allowed, according to legislation, 1 million as a lump sum. That's her 1/3. What is left is 2 million, 2.1 million, and she needs to withdraw an income from the 2.1 million. Whoops. Everybody can see the screen. I just want to make 100% sure. Give me a 0 in the chat if you can see the calculate screen. Thank you, Bronwyn. Thank you, Bronwyn. Mark Lee, the slide, I'll make the video available to everybody who registered. There's a link in my bio. If you registered, then I'll share the link. Thank you for the zeros. So let's do that again. So the total resignation benefit that they transferred, you can also call it a transfer benefit, is transferred to an approved fund of 3.2 million. They take their full 1/3, which will equal 1 million, and 2/3, according to legislation, needs to be invested for an income. Now, legislation says you cannot withdraw less than 2.5%, and you cannot withdraw more than 17.5%. My first question is, who can live off an income of 4,500 if they're used to earning a 400,000 Rand per annum salary? So 4,500 is going to be too little. The maximum they can withdraw is 17.5%, and that's 31,525 Rand. It's the maximum Jane can withdraw. Depending on your situation, and in this case, I made an assumption to say that Jane shouldn't withdraw more than 4%. And I recently made a video, and a lot of people have questioned why 6,000 Rand, why? Now, the reason I'm choosing 4%, it's what is called the 4% rule, if you want to look it up, by Bill Benjamin. It's just a worst case scenario where he had data of his clients. I think it was like 400 clients, and the clients, in one of the clients, the investment that did the worst, could only withdraw 4.2% in order not to lose his capital. So after he did his calculation, he said the 4% rule is if you withdraw 4%, and it's not a rule as in a rule that you should always follow, because you need to take into account the person's situation. But the 4% rule says if you have capital and you withdraw 4% of that capital will last you at least 30 years if you also decide to increase yearly your 4% with inflation. Okay, so that is what the 4% rule is. It's the worst case scenario. Worst case, you should take 4% because there could be bad market conditions. Markets are not always going to be good. And I'll show you what I mean in a bit. Now, if we compare what the GEPF gives us, the GEPF gives us 21,242 Rand. That equals almost 12% that you need to withdraw in order to break even with what the GEPF provides in this scenario. And that is 12%. Now, this is how the withdrawal and the growth works. If you withdraw 10% of your 2.1 million, you need to grow that 2 million with 10% if you want that 2 million to stay the same. If you want to keep your 2 million intact, the growth needs to be just as high as the withdrawal. Now, if you took the option of the 17.5% withdrawal, but your growth is only 5%, your capital will tend to 0. Your capital won't last because you cannot eat 7 apples and only put back 2 apples. You cannot eat 17.5 apples of your 2.1 million apples and only put 5 back. Your capital is not going to last. I want to know with the number 11, is everybody getting this first win? You need to do the calculation because in the calculation, you'll find the answer. Thank you for the 11s. Thank you for the 11s. Now, the reason why I did the 4% and the reason why you need to do the calculation is because investments can perform badly. So here, as you can see, some of the worst performing investments over a 5-year period was even in the negative. So you need to take this into account. And we did not even take into account Jane's medical subsidy. She will not receive her capped leave days. Funeral cover she needs to provide for herself because there's funeral cover within the GEPF. Increases. The GEPF also provides increases, and she loses the spouse's pension and the child's pension. Now, win number 2 is you need to plan. And the same as the mistake, without a plan, you're gambling on you and your family's future. Now, let me show you what some planning can do to your finances. Who would like to see with the number 12 how you can pay zero tax on lump sum withdrawals? Who would like to see? Who would like to see? Let me see number 12 if you would like to see. Otherwise, it's no use in me showing. Let me see if anybody wants to see 12, 12. All right, there's a couple of people. So for you, I'm going to show. So the first thing you can do to not pay any tax on withdrawals, as I said, you need to plan. So you need to know when you start paying tax on withdrawals. So depending, there's 2 tax tables when it comes to lump sum withdrawals. You get a withdrawal tax table. This is when you resign before the age of 55. And then you get a retirement tax table, and that's when you decide to retire. That is after 55. So if you want to pay no tax before the age of 55, you need to withdraw less than 27,500 Rand. Then you won't pay any tax. Otherwise, you will pay tax, and there's the tax table. If you withdraw less than 550,000 Rand when you retire, then you won't pay any tax. So that's the first way of how you can structure and how you can plan to pay less in taxes. The second thing you can do, you can transfer your withdrawal to an approved fund. So depending on your situation, whether you resign, get a new job, you can transfer your pension to an approved preservation fund. And in that preservation fund, you won't pay any taxes. There is consequences in a preservation fund, things you need to understand, but you can avoid the tax temporarily and have a better amount payout if you plan it accordingly. If you plan around your age and you plan around when you withdraw your capital. Would some of you also like to see how you can pay zero tax on two-pot withdrawals? Give me a 13 and then I'll show you how you can pay zero tax on two-pot withdrawals and that it is possible to pay zero tax on two-pot withdrawals. Give me a 13 if you want to see how to pay zero tax on two-pot withdrawals. And I'm going to share with you a calculator to show you how you can. 13. Okay, so people want to see. Let me get my spreadsheet. So I need to make you understand how tax work. So taxes work. You pay income tax on the amount of income you earn over a year period. So from the 1st of March until the 28th of February of the following year, all the income you earned over that period determines in what tax bracket you will be. So as you can see, if you earn less tax over a year period than 95,000 Rand, you won't pay any taxes. So if you structure your two-pot withdrawals when your income is less than 95,750, you won't pay any tax. So let me explain what I mean. If you earn an income of 30,000 Rand per month, okay, but you only earn that 30,000 Rand for 1 month, for March, because you resigned for whatever reason. If you resigned, and that's why I say you need to plan, if you resigned or you were retrenched or whatever the case, and you only earned a 30,000 Rand, let's say you for 2 months you worked, you earned a 60,000 Rand. So your annual income was 60,000 Rand. Then you won't pay any tax. Even if you withdraw, and this I can change to two-pot withdrawals, if you withdraw 30,000 from your two-pot, you still won't earn more than 95,000 Rand. So you won't be liable for any tax. So if you want to pay zero tax on your two-pot withdrawals, you need to withdraw or plan for your withdrawals when your income is less or very little. Because, and let me undo all that I did now. Because let's say you earn an income of 30,000 Rand, you are a 16% average taxpayer if you earn 30,000 Rand, and you decide to take a 30,000 Rand withdrawal, your income will increase from 360 per year to 390. And that will mean your percentage tax that you need to pay is 1% more. So they'll need to deduct the 8,700 Rand from your withdrawal, two-pot withdrawal. And that's how you can pay less tax, by planning and structuring your two-pot withdrawals that way. And the same applies for your capped leave. So your capped leave is also taxed as income. If you have a 45% tax rate, you are actually giving almost half of your working days away to SARS. Right? So I want you to understand that. So how do you think, how can you pay less tax on capped leave? Do you think it's possible to pay less tax on capped leave? Give me a 14 if you think it's possible. Give me a 14. Nobody thinks it's possible. If you want to pay less tax on your capped leave, all you need to do is you need to take leave, use your capped leave, use that capped leave. Because the less capped leave you have, the less tax you'll have to pay on it. And if you take leave, you'll still get your salary that is already taxed, but you'll still get your salary. And our time is more important than having 50% of our days paid out. If I can show it to you in value, then it'll make a bit more sense. So let's just as an example, I just want to show you. Let's say you earn 500,000 Rand a month, and this is just for calculation's sake. And let's say your cap leave is also 500,000 worth of rands, because that's your monthly, that's your cap leave. You will pay 225,000 Rand on that capped leave payment. So it's much better to use that leave days and spend the time with your family than paying almost half of that money in taxes. Win number three is you need to take action. Without action, I'm going to show you nothing is going to happen. You're going to stay behind if you don't take action. And this is for each and every GEPF member, and not even just the GEPF members. If anybody has a pension or any policy for that matter, please do the following. Let me make an example. So this is a scenario. A member has an adult child or children from a previous relationship. They're not financially supported and lives with a long-term partner, but they aren't legally married. If you do not update or nominate your life partner, the following is a likely outcome. So the partner must apply firstly to be recognized as a life partner. And that is why you need to take action. If approved, they may receive a share of the gratuity and spouse's pension. If they are not approved, but financial dependency is proven, the partner may get a portion of the gratuity only, not the spouse's pension. And I've seen a lot of clients miss out because they did not either recognize or apply for a life partner, or they did not nominate their beneficiaries. So this will not only delay payment, but it can also have negative effects where nobody receives that money. So please take action and nominate a life partner or register a life partner and also nominate beneficiaries. And if I can give you another tip, do this annually so that they can see it's still the same people. Or if it changes, if something happens, if there's a life event, it needs to be changed. Update your beneficiaries annually, and please update a life partner or do a life partner application on your pension fund. And here's such a good example of why you need to take action as soon as possible. So this is twins, Jane and John. They're both 26 years old. Jane starts saving 10K per annum, but she stops when she turns 36 years old. John decides, but I'm going to save 10K per month, but I'm going to start when I reach 36 and I'm going to stop when I retire. So as you can see in this example, if you start saving today in 2025, 10,000 Rand annually, and you stop after 10 years, but you keep on or you leave your investment as is, after 35 years, your growth will be 3.3 million. If you decide to delay or procrastinate and you are like John and you say, but I'm going to start saving, start taking action after 10 years, but I am going to keep on taking action for the remainder. John is left with 1.4 million after 35 years because he decided to not take action immediately. So please, it's important, and you can see the impact that taking action has. Even if John decides to increase his savings to 20,000, John will still not, he will still not be in Jane's position. So it's important that you start as soon as possible because the impact over a couple of years is dramatic. Now, Warren Buffett says risk comes from not knowing what you are doing. And I want you to remember that because the wins I want you to take home tonight is you need to do your calculations because the calculations is going to tell you a story. And without the calculations, You're not going to exactly know what you are letting yourself into. Just like the property scenario, if you don't do the calculation, you're not going to know what you are doing. If you don't have the competencies or the experience, you are not going to know what you are doing. The same example with the property. If you did not realize that you've already made payments, and you need competencies to realize, or you need the experience to realize this, you're not going to know what you are doing. And if you don't create a plan, you're not going to know what you are doing. And most importantly, if you don't take action on that plan, nothing is going to happen. So if there's anything I want you to take with you tonight, it's these four principles. Now, one of the highest school fees in South Africa per year charges 199,000 Rand. And it's a private school, and they charge that amount per annum. And most of the information I shared with you tonight, not even a varsity, I believe, has taught you. Maybe many of you, maybe some, but many of you might not have even known of the things I've shown you tonight. So there is a special offer for all the people that joined tonight. I do provide one-on-one consultations. I assist with calculations, whether it be GEPF tax, a financial needs analysis. I also provide you with that strategic financial plan, and I give you practical implementation steps to get to whatever you want to achieve. I'm also busy with a retirement guide. It's not, I don't have it yet, and I also have a beneficiary guide, but I'm still busy with that. And for tonight, but you need to let me know by next week, Friday. I have a special offer, and this is for the first 5 that contact me, whether it be via my email or TikTok or WhatsApp or whatever. I'll provide you with a consultation and all these benefits for 500 Rand. There's also a money back guarantee. So there's a 100% money back guarantee. If I cannot show you how to save at least 10 times that amount in tax, I'll provide you with a money back guarantee. And finally, if one, any one of those 5 are willing to provide me with a testimonial. So if I provide value, and if you feel that I assisted and there's value in that, I will even give you that consultation 100% for free. Thank you so much for each and every one that joined tonight. There's 9 minutes left, but I'm going to answer all the questions that I possibly can. I see our TikTok is quite a few of viewers, so the questions might be never ending. But all the people that joined the Teams webinar, I will be answering all of these questions. And after that, I'll go to TikTok and to YouTube. Thank you so much for taking the time, and let me get to the. Just finally, if this was valuable, leave me with a 14 in the chat. If you think this is valuable, if you think more people should know about this, if you think I should continue doing this, please leave me a 14 in the chat. Please leave me a 14 in the chat. Question. If you recently had an increase less than 12 months, do you add the 2 together and then divide by 2 to get the final salary? Francois, yes. So the final salary is the average of your last 2 years. But actually, the correct calculation would be to determine the amount of months you've received that salary. So yes, you are correct, but if you only receive that income for 2 months before you retire, you actually need to do a calculation where you use the month to calculate what your final salary is, because you only received it for 2 months. But you have the right idea. What they do is they look at your last 2 years and then they divide that by 2. I hope that answers your question. Let me see, what are the questions? Was the presentation so good that there's no questions? None. None. Good evening. I'm 57 and currently paying additional 4,000 on my provident fund. I currently have 2.7 million. What's my options? Angel, I'm not sure if you're still there, but you have a couple of options. One of the options, you can continue paying additional 4,000 on your provident fund. You can also decide to retire. And when you retire, you have two main options. You can either go with a life annuity, which provides you with a fixed income, or a living annuity. Life annuity is a guarantee, and a living annuity, you need to withdraw a certain percentage. And I explained it in the session between 2.5 and 17.5%. You can also have a combination, but those will be your options. You can also actually decide to move it to a preservation fund if you, for what other reason, maybe you find a new job or maybe you want to start a business and you're not quite sure what you want to do with your provident fund, you can also transfer it to a preservation fund. Hi, how is cap leave paid? I have 63 days available. Hi, Anne. How do you mean how is it paid? So it's paid and it is it adds to your income, your capped leave days. So you'll be taxed as if that is your income. But how do you mean how is capped leave paid? Next question. Where's the questions? Where's the questions? Here's another. Mine. TT Bengu. Educator, what do they pay per day? Is it lump sum that gets paid as extra? Yes, so it is a lump sum that they pay, but it's calculated, and this is what I believe, it's calculated as if that was a day's work. So if you have 63 days, what would you have earned in 63 days with your current salary? But then they pay it as a lump sum, so you can also think of it as being paid 2 months salary extra. So you're getting 2 months salary extra, and because you get 2 months salary extra, your income for that year is going to increase, and so your taxes are going to increase. So I hope you understand. Thank you, Anne. Mine at 55 years will be lump sum 248246 monthly 5598. What will be my final calculation after tax? If I look at it, TT Bengu, you won't pay any tax depending if you've had any previous lump sums paid, because your 248 is less than 550,000 Rand, so you won't pay tax on your lump sum, and your income is also less than the tax threshold, so you also won't pay any tax on your 5,500 Rand. Where will the balance go after 5 years if you don't have a spouse? So that's a good question, Tule, and I think I forgot to mention that if you don't have a spouse, and let me go back to that slide, if you don't have a spouse, nothing is going to pay to your beneficiaries after 5 years. Let me go back to that slide. It's this slide. Tule, you're referring to this slide? Where will all the balance go after 5 years if I don't have a spouse? So if you don't have a spouse and you pass away after 5 years, nothing will get paid. Right? Nothing, no balance. The only thing that will get paid is a funeral benefit and a child's pension if your children are younger than 22 years old or if they have a disability. So nothing will be paid. But that's why I said don't resign because of this. Because there is a solution and there is a way around not receiving a lump sum from the GEPF after 5 years. But as you can see in this example with the calculation, if you chose another route, your income might deplete and you might be left with no money, and your children will most likely need to look after you. So there's another solution for your question, Tule. That's why I said please don't resign because I showed you this calculation. Please don't resign just because there is a solution. It's not good reducing income benefit, Astro. Yes, it all depends on the person's situation. I think I'm back on. My headset switched off, so it's not a good to reduce the income benefit. Depending on your situation, it could be bad, it could be good. Everything depends on why they are doing it. Where can I get the slideshow, Mark Lee? I will make available if you registered for the webinar on Teams. Then I'll send you an email and you'll get a link to the webinar. And that's all the questions, it seems. Let me see if there's any questions on YouTube. It doesn't seem like there's a lot of questions, but there's a lot of people tuning in. Nobody on YouTube? I want to thank each and every one of you that came out tonight. Thank you for your time. Thank you for joining the live. Thank you for all the questions and the comments. I see here is another comment. But you must have approval for cap leave. Yes. So there's no other questions. If there's no other questions, I'm going to say thank you. Thank you for your time. Thank you for joining. Thank you for liking the live. Thank you for sharing. Thank you for interacting. I think the next one might be in a couple of weeks, or maybe I'll have another one. Maybe if people would like to know how to do calculations around their debt, maybe I should do something like that, or calculations around their property. So if you do have any feedback or anything at all, if you want to give me some guidance on what you would like to see next as a webinar, I can do one on taxes, I can do one on debt, I can do one on property and calculations. Please let me know when you see my videos, and then I'll do one next time just for you. Thank you for taking the time, for being here. I'm going to say good night because I don't see any other questions. Don't see any other questions. Thank you, everybody. Take care. Keep well. Thank you, Francois. Thank you, Anna and Anne. Thank you. To those who joined just now, I'm just signing out. You were just a bit too late, but I'll send out the webinar recording. Thank you.